I think the current assessment right now is that we've had a almost like the complete opposite of 2022, where I do believe 2022 was the beginning of something that may unfold for a much longer term. And this is not the end of it. In other words, this great rotation out of growth stocks and mostly technology companies into value companies, I think will continue to be the case. And I understand that recently what we've had is the complete opposite of that. In fact, with a lot of strength in terms of the mega cap stocks and other technology businesses and the AI popularity increasing and so forth. We also saw financial conditions ease up compared to 2022. We've had interest rates also not being as pronounced in terms of increasing yields like we saw in 2022. So a lot of things have helped to support the equity markets, but the economy itself is clearly getting into what we think it's going to be a hard landing. And at some point, we're going to start seeing again prices begin to really reflect this deterioration of cash flows and fundamentals. So we haven't seen yet in 2022, most of that decline in the 60-40 portfolios, equities and bonds and so forth was really, in my opinion, more of a duration reflection, more of a duration impact in those prices. In other words, interest rates rising, causing a lot of those also long duration assets to decline in prices. Now, do I think that's the end of it? I don't think so. That report that you're referring to was a report that we went really deep into the treasury market, where I think the treasury market is what holds the key for the entire financial system in a lot of ways. Is how we discount companies because of interest rates. It's also related to how liquidity may be impacting the overall economy. It's also involved with the collateral prices of the banks. If you remember, what happened with the banking crisis itself was caused by the decline of collateral prices, i.e. treasury securities, that really were the big portion of that issue. And so all of that together, to me, is pointing to a direction where I'm not sure the treasury market is, again, the safer place to be putting your capital, to deploy capital into a defensive asset. I think that we're in a transition away from that, where I think not only central banks, but also large institutions, the 60-40 portfolios will look more balanced and start allocating capital to gold. At the same time, all of that happening, we've had gold recently break out to new highs. It formed a triple top, and a lot of people lost faith on it in the short term. This is a classic shakeout period, in my opinion, before we make a breakthrough record levels and way higher than what we're seeing currently. And so, to me, this is the sort of state that we're in. A lot of people are worried about gold, how it would actually perform in a hard landing scenario. And I think this is going to play out very similar to the 70s in terms of market correlations. We can't use the 40s, and I'll explain this later, as an analog perfectly, because in the 40s, gold prices were pegged against the dollar. So the only alternative for most investors is really to buy treasuries. But I think this is not the end of the treasury market by no means, but the demand for treasuries will be in check. And that if the overall thesis for owning those securities is really predicated on the fact that we cannot raise rates sustainably because of the amount of leverage in the system, I would say that gold is a far superior alternative. And that's the whole point of that report, and a huge part of my views for the assessment of the global macro environment today. From the short side, I think mega caps, are risky part. I mean, I don't think that the overall market and the breadth of the market is telling you something that tends to be preceding a peak of the market, and you should be worried about it. I wouldn't have a large allocation there. Number two, private equity funds and other businesses that have private equity valuations. I think that those are yet to show very large mismarkings of their assets.
As they get forced to mark to market?
As they get forced to mark, I think they're coming. There's a lot of pressure of different regulators recently in that front. I think that that's going to become an important part of the market. I also think that corporate bonds look really troubling as well. So those are going to be important portions of the market. I think volatility is suppressed unjustifiably. I think there's certainly a case to be made that we may see that become an issue. And I look for companies that will have problems with high cost of capital. So that is one of the things in terms of shorts and things like that. Certainly has been a focus of ours, is to look for companies that will have that cost of capital problem moving forward, regardless if it is causing their margins to be squeezed, they're rolling over of their debt, and other problems that may be emerging because of the cost of debt being elevated. On the long side, well, I think the global fiat debasement is a real thing. I think, regardless if it is owning a defensive asset like gold for you, or if it is owning, to me, is really owning a lot of exploration assets. The reason why I think that way is because gold prices are basically near all-time highs, about to, in my opinion, break to that level. And as we see that, a huge influx of capital is likely to come into the market of the gold space. I think that the major companies lack vision. That's just my opinion. I don't think they're focused on growth, I think they have deteriorating assets. And so when I think about owning high quality assets in the space, I think developers and explorers are the way to go. We like explorers because we have a niche with an exploration geologist, but I think both sides of that market are much more attractive from an asymmetry perspective, but also just the quality of the assets relative to what the majors own. I like optionality. When I buy something, I like optionality. Optionality means having a large number of ways to be right. And in my opinion, what you mentioned about majors acquiring those businesses is just one of them. They are swimming in cash. Basically, they are being ultra conservative, which I think it's the wrong approach when you see gold prices at their levels and you're not producing. Most of the businesses, Barrick, AngloGold, Kinross, even Newmont, have been in a secular decline in terms of gold production. They're going to have, with deteriorating grades as well, at some point they're going to have to come in. So that's one thing. The second thing is just market or the industry receiving capital over time. I mean, if you see gold prices go up significantly from here, it is just natural that any institution looking for ways to capitalize on this will look for other things that are linked to gold prices that have not moved yet. And this might be the first time in my career that I've seen gold prices at near record levels and the valuation of exploration and development stocks near record lows.
Yeah.
And so, it's just sometimes it takes a trigger for that to happen. And I think the trigger is gold prices breaking out. We're all watching that match, the Treasuries versus gold World Cup final. Once that finalizes, I think everyone's going to be cheering on 60-40 portfolios, large institutions, endowments, funds, central banks. Everyone is seeing that happen live. And as we see that breakout, not only on gold itself, but also gold relative to treasuries, I think it's going to attract a lot more capital and interest to this overall industry.